When we do refer to A lender, B lender, private lenders, subprime, monoline, a prime lenders, it's good to understand the difference because we'll use these terms interchangeably, and we want you to be able to not get confused. So A lenders, prime lenders are mostly banks, big five banks, and then what we'll call monoline lenders. What are monoline lenders? Those are at times subsidiaries or partners of those big five banks, but those are investor-driven lenders that have no retail branches. So there's no ATM, you can't walk in those institutions to deposit your cash. They don't do that, but they do lend money on prime real estate, do subprime lending. So subprime lending institutions like Equitable Bank, called bank, Home Trust, RFA, a Community Trust, and those guys. So those would be subprime B lenders. They would deal with people with lower credit, sub 600. They do have a minimum. Some of them would be 500. Some of them could go down to 480 with some conditions, but they do operate in those areas where people have damaged credit, bankruptcy, self-employed without taxes, non-conventional income types, people who haven't paid taxes, people who have been bankrupt, consumer proposal, people who had damaged credit, people who can't show much income on their tax return because they deducted so many expenses to pay less taxes. So those areas, some properties that prime or A lenders won't deal with, those subprime B lenders will deal with. And then you have your traditional private mortgages that will go with more equity-based lending, so value LTV of the property compared to traditional income and traditional debt servicing ratios. They will tend to be more flexible, but this comes at a price. The interest rate might start around 7-8%, go up to 16-17% with fees. So good to know what those three tier of lenders is, because we will always refer back to those. So now you have something to at least reference going forward.